On July 1st, reports broke that Meta is building a cloud business to sell its excess AI compute. The stock jumped 9%. Wall Street called it genius. Look closer. Meta and xAI, two of the biggest buyers of AI compute, are now turning into sellers. The last time a setup like this peaked, in March 2000, the Nasdaq lost nearly 78%. Here's why that's your problem. If you hold an S&P 500 fund in your 401k, roughly 40% of your money sits in just 10 companies. That's not diversification, that's a concentrated bet. By the end, you'll know if that money is riding this bubble, and the 3 warning signs to watch before the headlines do. Start with the size of this thing. Big Tech has over $700 billion of AI capital spending planned for 2026, up nearly 80% in a single year. The Big Four are planning north of $100 billion each. Money for chips, data centers, and the electricity to run them. Nvidia, the chip maker at the center of all that buying, is now worth roughly $5 trillion. And the Bank for International Settlements, the central bank of central banks, just looked at this whole machine and put a warning in its annual report. The 5 biggest cloud giants will spend over $1 trillion on AI across 2025 and 2026. That's more cash than their businesses actually generate, so some of them are borrowing to cover the gap. The BIS compared this build-out to canal mania in the 1830s, British railway mania in the 1840s, 1920s electrification, and the 1990s dot-com boom. Every single one ended in an economy-wide recession. But here's the part that should stop you cold. A chunk of the demand is money moving in a circle. Chipmakers and cloud giants buy ownership stakes in AI labs, and those same labs commit to buying chips and computing power from the companies that just funded them. Nvidia pledged up to $100 billion to OpenAI, a deal that has since stalled and shrunk to about $30 billion, while OpenAI committed to buying Nvidia systems with that same money. Same dollar, counted twice. The BIS put it bluntly, these circular deals are typically poorly disclosed, with risks of the same asset being pledged multiple times. Which brings us to the price tag. There's a gauge called the Shiller-Cape ratio, basically the price of the whole market measured against 10 years of real earnings, so one hot year can't fool it. Today it sits around 41. The market has only ever seen that level once before, the dot-com bubble. Warren Buffett's favorite yardstick agrees. Take the total value of the US stock market and divide it by the size of the US economy, and at the end of the first quarter, you got 219%, far above its long-term trend, about as stretched as that gauge ever gets. Daily trackers now put it above 230% as of mid-July. In plain English, the market is now priced at about 2.2 times everything the country produces in a year. But here's where it stops being abstract. RBC Wealth Management, crunching FactSet data, found that at the end of 2025, the top 10 stocks were about 41% of the S&P 500's weight, but produced only about 32% of its expected earnings. You're paying for 41 and getting 32. For most of 1990 through 2015, the top 10 hovered between 18 and 23% of the index. Even at the peak of the dot-com bubble, the most concentrated market in a generation, they only reached about 27. Today's roughly 40% sits above that peak. Comfortably or uncomfortably depending on how you look at it. And it gets tighter. The 7 big AI-era tech names alone are about a third of the entire index. Concentration has roughly doubled in a decade, and nobody asked you if you wanted that. So if the market is this stretched, are the smart people still in? The biggest insiders are quietly switching sides of the trade. SpaceX, which merged with Elon Musk's xAI earlier this year, priced the biggest IPO in history on June 11th and raised $75 billion. Then, less than 2 weeks later, it went back to the market and borrowed another $25 billion in bonds. A record share sale at the top, then straight back for debt. That's a company that's very hungry for cash. And what is xAI doing with Colossus, its giant data center? Renting it out. Anthropic pays $1.25 billion a month for capacity. Google pays another $920 million a month, calls the deal bridge capacity, a stopgap, and can cancel on 90 days notice after the end of this year. Now put those July 1st Meta reports next to that. You don't sell your extra computing power when you're starving for it. You sell it when you built more than the demand that showed up. Then there's Oracle, the stress test hiding in plain sight. Oracle's capital spending hit $55.7 billion this fiscal year, more than 2.5 times the year before. Its free cash flow, the cash left over after paying for everything, came in at negative $23.7 billion. Total debt, roughly $130 billion. Oracle also cut 21,000 jobs this year, about 13% of its workforce, while pouring those billions into data centers. In late June, the stock fell 19% in a single week. Its worst week since 2001, the dot-com bust. And here's the kicker. Oracle's biggest cloud customer is OpenAI, a roughly $300 billion contract. OpenAI just lost over $21 billion in one quarter, and to be fair, roughly $12 billion of that was non-cash accounting charges, not money out the door. But the company doesn't expect to turn a profit until around 2030. That over-reliance on OpenAI for expected revenue led S&P Global Ratings to cut Oracle's credit rating to BBB-, one notch above junk. So the buyers are borrowing, the sellers are cutting jobs, and the biggest customer in the chain loses billions every quarter. Has this exact setup happened before? It has, almost move for move. March 2000, the Nasdaq peaks at 5,048, then loses nearly 78% over the next 2.5 years. Adjusted for inflation, people who bought that top waited about 18 years until 2018 just to break even. The company at the center of it was Cisco, the Nvidia of 1999. Cisco sold the routers the internet ran on and controlled well over 2/3 of that market by most estimates. In late March 2000, it was briefly the most valuable company on earth, worth about $555 billion, trading at roughly 200 times earnings. And here's what matters. Cisco was real. About $19 billion in revenue that year, up 55%. Real products, real customers, real dominance. The stock still fell nearly 90% and took more than 25 years to reclaim its 2000 high, a record that only fell this past December. Why did a real company crash that hard? Because the money was circular then too. Cisco, Lucent, and Nortel lent telecom startups the money to buy their own equipment and booked those sales as revenue. They called it vendor financing. And when Lucent's version unwound, it was owed more than $6 billion. 25 years ago, that was a lot of money. Telecom companies poured over $500 billion, most of it borrowed, into fiber optic cable. By some estimates, 85 to 95% of that fiber sat dark for years. WorldCom, the phone giant at the center of that build-out, collapsed into what was then the largest bankruptcy in American history. The internet was real. The demand at those prices was not. And while regular investors were told the internet changed the rules, insiders cashed out $43 billion between September 1999 and July 2000. By one accounting, twice the pace of the 2 years before. The crash came when the checks stopped, not when the routers did. Now the math almost nobody runs before a crash. Say you have $100 in your fund and it falls 78%. You're left with $22. To get from $22 back to $100, divide 100 by 22. That's about 4.5, meaning your money has to multiply 4.5 times over just to get back to even. That's why the hole took about 18 years to climb out of. Losses are a trapdoor and gains are a staircase. So what do you actually watch? Not the headlines, because headlines are the last thing to break. You watch the 3 upstream canaries, the places where the loop cracks first. Signal 1, compute buyers turning into compute sellers. That's the Meta reports, and it's xAI renting out Colossus to Anthropic and Google. Signal 2, data center projects getting delayed or cancelled. There's already a wave of reported delays and cancellations, though the true size is disputed, and one respected industry analyst says the scariest numbers are wildly overstated. You don't need the scary version, you need the direction, so watch whether new builds keep breaking ground. Signal 3, chip demand cracking. Nvidia's order book sits at the bottom of this entire pyramid, so if the circular deals stall, the way that $100 billion OpenAI pledge already stalled and shrank, chips are where it shows up first. Now the honest part, because this channel deals in physics, not mysticism. I'm not telling you AI is a hoax, and I'm not telling you it pops next Tuesday. The technology is real, exactly like the internet was real in 1999. Goldman Sachs runs a bubble gauge and it sits at the 86th percentile today. Elevated, but below the 100th percentile it hit in 2000. Goldman itself argues this rally is driven by earnings more than hype, and prediction markets put the odds of a recession at under 20%. So markets aren't even pricing a recession, which may itself be the trap, and a bubble can stay inflated longer than you can stay patient. But frothy is not safe, and you don't get to reprice your 401k after the fact. So here's the plan, and none of it requires predicting anything. First, today, pull up your main fund and read its top 10 holdings, and what percentage of the fund they make up. Not the fund's name, the actual list. Most people have never read that list once. If you're anywhere near that 40% mark, you finally know what you're really holding. Second, watch the three canaries, not the headlines: sellers of compute, stalled data centers, cracking chip orders. Third, set your rebalance rule now while it's calm. Decide in advance how much concentration you'll accept and exactly what you'll do if the market drops 20 or 30%. The people who got wrecked in 2000 weren't stupid. They were making decisions in the middle of a panic. Do those three things and something bigger shifts. You stop being a saver who owns whatever Wall Street packaged and mailed to you, and you become an investor who knows exactly what you hold and exactly what breaks it. In 2000, that was the whole difference between the people who recovered and the people who never did. Because the question was never whether the AI bubble pops. It's what you're holding when it does. Here's my question for you. Pull up your fund's top 10 holdings and tell me in the comments what your concentration number is. I want to see how exposed this audience really is. And keep the momentum going. Watch, is the US planning a $50,000 gold revaluation? It's on your screen. And subscribe, because when these three signals start firing, this channel will cover them while they're still upstream, before they become headlines. Remember, this isn't personal financial advice, it's education so you